So, we're into the second trading week of the year now, and if last week's anything to go by, we're set for a stellar year in terms of trading opportunities. Last week was very much about China driving the market volatility, and to be honest, I think this is likely to be the case for a while. Every year, we seem to have a few major themes driving the market, and 2015, last year, was very much about Greece in the early part of the year. Will they leave the euro, won't they? Will they default, won't they? Oil was a concurrent theme throughout the year. Towards the end of the year, China had major volatility and major impacts on the market, and throughout the year we had Yellen and the FOMC. Now this year, many of those themes will still persist, I think. Greece seems to have sorted itself out for a little while, so I don't think that will be too much of a market mover this year, but China, the FOMC, and oil will definitely be themes, I think, that persist into 2016. So we've seen last week the Chinese currency and the Shanghai indices providing a lead onto markets, and I think that will very much persist into the first weeks or months of this year, with very much risk on, risk off, depending on Chinese stock markets and the currency. Central banks this year should also be of great focus. We had the Fed for much of last year providing decent volatility in the bonds, in the currencies, and in the equities. But this year, later on in the year, we should get the Bank of England also coming into play. So not only will central bank meetings be very important and speakers taking a front seat in terms of our trading activity, but economic data points and data prints will probably take even more importance in this year's trading than it has in years gone by. I remember when I started my time in the markets back in 2005, every data point, every event was very closely watched, and we're not quite at that stage at the moment. It just seems to be the inflation and employment numbers that are providing the volatility. But as time goes on, as we hike rates in the US, as we hike rates in the UK, there's potential to go both ways with rate hikes going up and down. So every piece of data may become more important. So I think this year, more so middle to end of the year, there'll be so many central banks in play potentially, and the economic data in conjunction with central bank policy, etc., will really provide some good volatility in the markets and some great trading opportunities, I hope. Another theme for this year, oil, low oil prices. They've been around for a while, and it doesn't seem like they're bouncing anytime soon. And I think this will eventually result in more spending for the consumer, and could eventually prove bearish to bonds and bullish to equities if we see this feed into the data. For much of last year and the end of 2014, I guess, it was low oil or declining oil prices was pretty bearish for equities. Actually, every time oil went down, equities went down, and so on and so forth. Now, I think so long as the low oil prices are a function of excess supply, I actually think in the medium term this will actually reduce saving. People have more disposable income, will spend more, will feed into into inflation numbers, higher inflation, higher growth, and so on and so forth. And a lot of central bankers have said this as well. So I think if it is continued low oil prices from supply-driven factors, it should actually be positive in the longer term for the economy, and we could actually see bearish moves in bonds as a result, and bullish moves in equities. So equities going up. We haven't seen that very often, but I think later on in this year that could emanate itself if indeed the low oil prices continue to be supply driven. Now, if it is demand driven low oil prices, then that's a different story. But by and large, it has generally been supply led for much of the last 18 months or so. So equities themselves this year, I think it'll be pretty tricky, to be honest. Any uptick in US data should be bullish for equities. The economy is doing well, things are economic growth, inflation, what have you, ticking along nicely. But now, given the Fed are in play, they hiked rates in December, any kind of positive uptick in data could actually mean that the Fed will provide some sort of handbrake, and maybe hike rates through this handbrake. So, any bullish move in equities on the back of positive economic growth, a better outlook, etc., could be slowed down by Yellen on any potential recovery because of interest rate hikes. As we know, equity markets generally don't like higher interest rates, and rate hikes could be used to stem any economic growth, and hence I find it very difficult to see a scenario where equities continue to go up and up and up. So that leads me on to something else for this year that not many have talked about. A situation where both equities and bonds struggle to rally, or actually both weeks. So if equities goes down, bonds go down. This could happen in an environment of rate hikes and this sort of handbrake I just talked about placed by Yellen. This could have quite a few implications on long-only asset managers in terms of them having to liquidate longs. Where will they get their returns from if bonds are going down, if equities are going down, if commodities remain low? We don't often see a persistent period of weak bonds and equities, but if these do materialize, we could see a few bloodbaths in the markets, especially if commodities continue to struggle. I think it's probably something that we should be more concerned about later this year, but you know, asset managers, especially the long-only ones, they need to get returns somewhere, and if things continue to go down, whether it's bonds, equities, and if they all go down together, there's going to be a lot of stops triggered. There'll be a lot of liquidation of long positions, and it could be a difficult year this year for asset managers. So essentially, I think it will be later this year that we'll see these opportunities. But you know, I don't want to talk about potential flash crashes, but this is a sort of scenario where we could see possibly a few of these in multiple markets at different times this year. Finally, currencies, I guess they'll continue to do what they do. And I don't have too much of a view on what the currencies will do this year, but we have seen in the last year or so numerous central banks making direct mentions to their currency at policy meetings. So there's a possibility that we might see extended currency wars this year. Again, it's very much a case of watch this space and probably something for later in the year. But last year, you know, we had early last year the SNB, the Swiss National Bank, removed their peg. We've seen the ECB and Draghi talking about the euro being a little bit too high. We've seen the RBNZ, the RBA talking about their currencies being overvalued. We've heard Yellen talk about potentially the dollar providing a strong dollar squeezing or preventing inflation from upticking as much as it should. So, you know, while it's not a policy tool of central banks, a lot of central banks have been talking about their currencies, and it could be something that materializes later in the year, some sort of currency wars. Okay, that's it from me really, with my views on what we may see in 2016. Obviously, there's a whole load of other things that might happen that we can't really plan for. Obviously, we had the Paris attacks earlier, late last year, and acts of terrorism. There'll be these things that will continue to go on from time to time, which will obviously change sentiment in the markets. But in terms of things that we can probably plan for a little bit more, those are my thoughts. I'd love to know what anyone else thinks as well for the year ahead, so please feel free to get in touch with me via Twitter with your thoughts if you wish. My handle is @IMI_Futex Live. Thanks very much and happy trading for this year. Good luck.